Welcome to another of the FinTalks series of podcasts organised by FinanceMalta. I'm Vanessa MacDonald, and we're here today to talk about capital markets, which actually sounds like a very large subject, but I'm sure that with the help of Rory Renshaw, a partner at Simmons Simmons, we'll be able to cut to the chase. And I think the main thing that you would like to discuss is really the fact that there are so many people who have savings and deposits and so on, who are not, maybe they're a little bit wary about the capital markets and so on. Apparently there are trillions just sort of lying around there, which are not being leveraged to help either European competitiveness, to help people get the access to finance that they require. Why is this, Rory? What is holding people back?
Yeah, no, I think that's right, and thank you, Vanessa. Pleasure to be here. But no, I think you're right, and that there's all sorts of kind of things and aspects in what you've just said, which are interesting and kind of need unpacking. The reason for it, that what you're saying is that the capital markets is kind of excludes the retail investor, certainly from the debt markets at the moment. Is really because of the way that the regulation has evolved over the last 25 or so years, since the turn of the century, and the prospectus directive, which was rolled out across Europe in around 2005, actually, is kind of predicated on the idea that the way to protect investors is to produce a prospectus, which is a big disclosure document. It takes a lot of time to put together. There's a liability attached to it because if there's things in it which are wrong, an issuer could get sued, and so could his advisors potentially. So mainly because of that, the market has kind of bifurcated into an institutionals-only market, which is the vast majority of the capital markets, and then a very small kind of domestic market in each country, which operates in a very different way. But the bulk of the big issuers, and that's generally the big investment grade corporates that you've heard of, and banks and sovereigns and supranationals, they generally raise their money exclusively from institutional investors. And in order to make it efficient and to alleviate liability, they do everything they can to avoid the regulation. So they avoid selling to retail investors. They issue in large denomination sizes, which effectively excludes retail investment anyway, because most people don't have 100,000 euros to kind of invest in one bond. And that's the way it's been, really, for the last 20 years or so. What's happened now in the last few years is the policymakers throughout Europe, particularly in Brussels, but in each state, is realised that we're all getting a bit older. None of us are saving enough for our retirement, and we need to invest more, and there's more pressure on public finances.
But the big corporations are getting the money they need. Institutional investors have treasury departments, as big as the delegates at the FinanceMalta Conference. They're not really worried about it. So
absolutely, yeah, you're right.
What are you going to change? You can't reduce consumer protection, can you?
You're absolutely right. The big corporates are raising as much as they want.
Yes.
What's happened now is, firstly, the policymakers are seeking to kind of invigorate investors just being able to put in a small amount of money into these investments.
As you say, for pension reasons
for
and
demographics as well. And there's all sorts of statistics per member state or throughout Europe, but even if, people could be encouraged to put 5% of the cash that they currently have sitting in effectively current accounts, cash savings, that would amount to over €1 trillion across Europe.
5% of it. Imagine if they did more. Gosh, that's a tremendous amount.
Exactly. But clearly, some people are never going to do it, and some people are not going to have enough to do it. And a lot of people invest in the equities market as well, particularly depending on their stage in their life and their risk profile. But the other thing that policymakers are conscious of is that SMEs, very small companies that just want to borrow 20, 25 million, are also effectively excluded for various reasons from the larger bulge bracket capital market deals. That's partly because the investors in those deals, the big bulge bracket well-known investors, they're not really interested in investing in a deal on the capital markets, which is only 30 million euros equivalent size. There's a lot of SMEs now that need to borrow money, and they want to do it more cheaply than they've historically been able to do off banks. So that's another reason why policymakers are kind of re-looking at this and rethinking about how they can incentivize both those kind of smaller issuers into the market, but also retail to be able to get their money into the market as well.
So that's really interesting. So we're not just talking about the retailers getting, pensions and getting better return and so on. We're actually talking about the competitiveness of Europe now.
We're talking about the competitiveness of Europe, and the ability of our corporates, our industries, to be able to raise money cheaply and efficiently.
You mentioned the distinction between domestic markets and international markets. Is that the role of domestic markets? Is that how you see us coming into it? Because Malta is one of those small domestic jurisdictions, I suppose.
Yeah, well, Malta is not unusual in many ways in that it has its own domestic market, a place where local businesses, be they classically local property businesses, building hotels or residential, want to be able to raise similarly small amounts of money, 20, 30 million euros. They can do it now on the Malta Stock Exchange. And you have equivalent kind of small domestic markets in the UK and elsewhere in Europe. Some of the European markets, culturally, they are just more sophisticated, the retail community, and they do it at a bigger scale. Italy, Germany, for example, some of the big corporates there do kind of more commonly raise money off their retail investors. But certainly in the UK, that really hasn't been done in any meaningful way for the last 20 years. So our retail market, bond market in the UK looks kind of similar like Malta as well. We've all got the same problems, yes. Exactly. We all, and those markets, they all suffer from the same problems. Big institutional investors aren't encouraged to get into them because the deal sizes are too small and they lack liquidity. And for everyone else, they do just lack liquidity. Tradability is an issue. Transparent pricing in the secondary market is an issue because there's not a lot of trading going on.
In fact, that's one of the questions I was going to ask, the drawbacks of being a small jurisdiction, because things like ratings and so on are extremely expensive for a small jurisdiction, and very often, Malta, for example, we don't have any. We don't have market makers, we don't have a real secondary market, so...
Yeah. No, ratings are certainly prohibitive for a very small issuer. They're very time-consuming, very costly, and frankly, actually, a lot of the issuers that would want to come to the market would drop so low down on the scale of ratings compared to what the sort of investment grade institutionals are looking for on that side of the market that, it's really not a meaningful comparison. And then, market making is a problem. It's very difficult, and stock exchanges struggle with this across Europe to kind of incentivize people to offer a market in bonds. Bonds are different to equities for all sorts of reasons in the way that they trade. They don't generally trade on a stock exchange. They trade OTC. There's lots of structural reasons for that, but one of the reasons is that generally in the side of the institutional market, trades happen at a big scale, 5 million, 50 million, 100 million ticket sizes. In the equities market, classically more commonly held by retail investors, much smaller trades are happening, very small sizes. And
people tend to hang on to their
People tend to
equities,
hang on to, they hang on to their equities, but on the debt side, there isn't a kind of a constant universe of buyers and sellers out there that want to be selling in 100 million ticket sizes and buying in 100 million ticket sizes. So small changes in the economic climate or in the credit, the health of the issuer, don't necessarily immediately result in trades where you can see a discernible change in the trading price, unlike in the equities market, because it's happening so quickly.
You referred a little bit to the prospectus, that it's sort of there to protect the consumer and so on. Do they actually ever read the prospectus?
Well, that's another thing that I think policymakers have kind of changed in their thinking on. The whole prospectus regime, which brought about in 2005 with the prospectus directive across Europe, and subsequently it's now the prospectus regulation. But it's really predicated on the idea that investors, their protection is the prospectus, and they read the prospectus, and that tells them all the risk factors and the features of the securities they're investing in. People have come to realise that, somewhat slowly, that investors don't generally read a prospectus in that way. They look at the coupon, the interest rate, and the return, and they generally go for the one that pays them the most. So there's been a sort of shift in the mindset of the policymakers in order to alleviate the kind of the focus on the prospectus and the disclosure, and to look more at the intermediaries in the chain who are regulated by the MFSA in the case of Malta, or the FCA in the UK, or Central Bank of Ireland in Ireland. Whoever the kind of competent regulator is around Europe regulates their kind of local distributors, people who put bonds together, arrange deals in bonds, sell them, and facilitate the trading, brokers effectively in the secondary market. Those people are all regulated, and now the focus is really on them to be doing more of an assessment as to whether or not a certain product is suitable for the type of client that they're talking to, if that makes sense.
Thank you so much for sharing your insight with us. I'm sure it's going to be very helpful out there, and let's hope that it G's up enough people to try and get things moving here in Malta as well.
Yeah,
thank you for being with us, Rory.
Pleasure.